how to incorporate structured notes into your portfolio, show you a customized note that we've written for our clients, how to customize a note for someone's specific situation. Better terms than the version that you are owning. They have protection, they have participation, and that's in exchange for dividends, liquidity, which if you're a long-term investor, it shouldn't be a concern. Now, they're great fixed income alternatives, but also you have to keep in mind that these protections lower the volatility of the performance of the notes. So you're actually able to get growth notes on equities that have the same volatility as bonds. So you're actually able to take risk in positions that have greater volatility when they appreciate and less volatility when the market sells off or goes down. So this is that's the way you want to structure your volatility for specific views or specific situations. One note I'm going to highlight that we've put together for our clients, which was tremendously successful, for Japanese equities. You used the worst of format between the Nikkei and the TOPIX. Those are both indexes of the Tokyo Stock Exchange. They're calculated differently. A 5-year term, again, 30% barrier contingent protection. And we got a multiplier of 2.52 times. Why did we do this note? Well, we thought Japanese equities were undervalued. We can go back to the quote about diversification from Vanguard, and getting a multiplier is certainly when you think something is undervalued is great. We also had a view on the currency and on the interest rates between Japan and US, and which made the note more favorable than buying indexes on their own. Now, I mentioned before we talked about a rainbow option. This is another note that we issued. And the reason I liked this note was because it was based on the S&P 500, the NASDAQ, and the Russell 2000 on the Futures Excess Return Index. But we're putting it in a note. So those notes could have much better terms, right? So we used a 5-year term, and I didn't use protection on this because I used a rainbow option. Now, what is a rainbow option? It's a weighted average, 50% best performer, 20% worst performer, and 30% median performer. Well, it's exceptionally better than the worst of note, right? Because this one's only getting 20% of the worst performer and 50% of the best. It also has a 1.71 multiplier. I'm replacing existing exposures that are already in my portfolio. I'm getting a weighted average of 50% of the best performer. I'm getting a multiplier of 1.71. But when we look at multipliers on these cash indexes, one that's a worst performer of those, you get a 1.6 to 1.8 multiplier. I'm getting only 20% of the worst and the same multiplier in the futures excess return for 5 years. Here's a customized solution. You bought a stock for $10,000 and it's now worth $100,000. You have a $90,000 gain. You're afraid the stock might retrace short term, but you don't really want to sell because of tax implications, right? So those tax rates I have up there, you're going to be paying about $27,000 on. You'd be left with $73,000. So you have to say, is the stock going to fall 27%? You might want to mitigate some short-term losses. You keep the stock and you buy a structured note. The time period we picked was 1 year and 1 day. All the gains are treated as long-term capital gains on the note, as opposed to be treated as income. What was going through my mind is, okay, this client has a lot of money in bonds. Let me create a note. This underlying stock goes up, is going to pay them a bond-like return because they already own the stock, and then they're going to get their bond return. The note is replacing what the bonds do. Stock is up, you get a 50% participation to a cap of 10. So your maximum gain is going to be 5%. Stock goes up, you're going to make money on the stock. Stock goes up, the note's going to pay you like a bond. Now, what happens if the stock goes down? Well, we want to have an absolute participation. Stock goes down 10%, you make 7.5%. Now, what type of protection are we going to have? With the buffer, a buffer would give us protection down to 26%, meaning that if we got down to almost 26%, 75% of that is you would be up 19.5% on the note. But if at maturity it's down more than 26%, let's say 30%, you would actually lose 4%. The barrier level is 37.5%. If you don't think the stock is going to go down that much, maybe this is the better version for you. And the max payoff would be a little bit over 28%. The stock is down at maturity. These are two excellent alternatives to selling the stock. Dark purple line of keeping the stock is in tandem with owning the note. So if the stock does crash out, well, you're in a bit of hot water where, hey, I get to keep my stock and not pay taxes. And instead of keeping money in fixed income, I buy the note, which will make money if the stock goes down initially. Buffer makes less money. The barrier can make more, but can lose more. And you're still making a 5% return if the stock goes up, which is greater than what you'd earn in the fixed income.